The Tesla ETF just announced a 1-for-2 reverse stock split. That is reverse with a capital R for risky. This has a serious negative connotation, and we're going to unveil in this video what's really going on behind the scenes with this product. Effective February 26, 2024, a reverse 1-to-2 ratio stock split will be occurring for the YieldMax Tesla ETF. What this means is that for every 100 shares of stock of Tesla you own today, you are going to see your account go from 100 to 50 on that trading day, February 26th. Now, fundamentally, nothing will change. The amount that you have invested in the product will not change. Just the number of shares you own is going to be the only thing that will be updated when you log in on that trading day. However, a study published in the Journal of Applied Business Economics back in 2019 looked at 25 reverse stock splits from 2015 to 2018 and noted the market has punished, let me repeat that, has punished companies following transactions of reverse stock splits. And in my opinion, it will be no different come February 26th for Tesla. The stock has been on a severe decline, mirroring that of the performance of Tesla. And as you know, what happens to Tesla on the negative side is reflected almost 100% move for move in Tesla when Tesla does start to pick up and perk up due to the nature of how the Tesla product works. The entirety of the upside move isn't captured. So it's a negative return that is magnified and a positive return that is kind of almost mitigated when you're looking at this Tesla product. So presumably, if you own Tesla today, based on historical patterns and studies, it would be a good time to think about reducing your position size in advance of February 26, 2024. YouTube, Reddit, even Twitter are all up in arms, arguing back and forth over the nature and the impact of this announcement, and also what it means for the other ETF products from the YieldMax brand. And now you may be asking yourself, why would Tesla or why would YieldMax do this? Why would this happen? Well, a stock is only reverse split for a number of reasons. Firstly, it could be to keep the overall price of the stock above the certain limits to stay on regulated traded bodies. For example, if the price gets too low, under $1, let's say, it could be listed as a penny stock or delisted entirely, eliminating the ability for investors to buy into the product. That is something that YieldMax does not want to have happen. The reason number two, though, is to prop up or kind of artificially enhance the price of this stock or product to make it more attractive to institutions and larger kind of corporate bodies that have minimum thresholds for prices that they don't want to go below. It's seen as more risky to invest in stocks or products with lower stock prices. And one other question you may be wondering about is what happens to the share that you already own? If you have an even number of shares, let's say 100 shares again, that number will be cut in half on the 26th of February. So 100 goes to 50 and nothing else changes. But if you have 101 shares in your account, it's very likely that you'll still get split down to 50 shares, and then you'll just be paid out for that singular share that's left over. The alternative to this, which is probably not very likely, is to get a fractional share in your trading account, but it's much more, again, likely to just get paid out at the fair market value for that one outstanding share that can't be split evenly. So the big takeaway is that this is a smokescreen coming from the YieldMax ETF team. The Tesla product is in distress. This is another signal of that to confirm it, and they are artificially trying to prop up this product and make it look better and more attractive than it really is. Historically, a reverse stock split is a sign of weakness. So if you do find yourself holding a position, it's time to make a decision long-term for what you want to do with this product. It is going to be a rocky road ahead with lots of volatility. Tesla's already a volatile stock. Tesla is predicated, it kind of mimics the movements of that underlying performance of Tesla. So buckle up if you have shares. If you want to get into the product, do your research and due diligence before doing so and understand what a reverse stock split means for the stock moving forward. If you have shares yourself and are going to buy more, let me know why in the comments. I want to hear the justification from the Tesla bulls that are still out there at this point after all this negative data. Thanks so much for watching this video, and I'll catch you on the next one.